Hi folks, so Alibaba stock has been on quite the ride recently. Since their quarterly report dropped, we've seen a nearly 30% spike, but now it's pulling back a bit. This begs the question. Firstly, with Alibaba's recent dip, is this still a good time to jump into it? And second one is, what's the target price we should be aiming for? I'm Sheila Wang. I'm here to update it on the most cutting-edge and fresh business and investment information for you. So don't forget to smash that like button and subscribe my channel. I also welcome you to join the discussion in the comment section below. Right now, Alibaba's rolling PE ratio sits at around 910, and get this, its stock has more than doubled this year. We've had a couple of key turning points that fueled this surge. First up, back in February, Alibaba announced that they'd be investing a whopping $38 billion into cloud and AI over the next 3 years. That news sent the stock price skyrocketing from February to March, effectively doubling it. Then, in September, when they released their first quarter earnings, the numbers were impressive. Thanks to fierce competition into the food delivery space, Alibaba saw a huge jump in the net profit, while their rival, Meituan, pretty much saw their vanish. This led to a second wave of growth for Alibaba, while Meituan has struggled ever since. Alright, let's dive back into our first question. With Alibaba stock soaring this year, is this still a good time to invest? When we talk about investing in Alibaba, we can break it down into three main factors. First, there's belief that AI is the future, which boosts confidence in Alibaba's cloud and AI business. Second, Alibaba has recently won its first major business battle, showcasing its potential in the Chinese consumer market. And the third one is the return of Jack Ma and Jiang Fan, has many optimistic news about Alibaba's future. Let's unpack this one by one. About the huge potential in cloud services. Charlie Munger probably doesn't realize just how significant cloud is within Alibaba's ecosystem, and it's only going to get bigger. So he said,
Alibaba is one of the worst mistakes I ever made.
Considering cloud services and AI, Alibaba is no longer just a traditional e-commerce company. It's more comparable to Amazon, which has a PE ratio of 32. Rather than rivals like Jingdong and Pinduoduo, both Alibaba and Amazon focus on e-commerce and cloud services, with Alibaba's cloud making up about 12% of total revenue, while Amazon's is around 16%. Amazon leads globally in cloud services, with Alibaba sitting in third place. But when it comes to AI, Alibaba holds its own against Amazon. Alibaba's Chain 1 open source model often ranks as one of the top models worldwide. Alibaba's AI capabilities are top-notch too, not just in China but also globally. Plus, they even have their own chip business, while Amazon doesn't dabble in that space. Recently, at Alibaba's Cloud Summit, three key points stood out. They announced a massive investment of 38 billion yuan in AI infrastructure and plans to build and expand several data centers. They also partnered with NVIDIA in the realm of physical AI to enhance AI development infrastructure. And they also launched their powerful Chain 1 Max model, which ranks among the top 3 globally on authoritative lists. All these factors combined have driven up the stock price, primarily fueled by optimism around future AI business. But whether this surge can continue will ultimately depend on whether these massive investments translate into growth in cloud services and AI-related revenues. Now, onto the second sector. If you are only investing in Alibaba because of its booming food delivery business, it might be time to reconsider it. Why was Alibaba's stock stagnant before this year? Because it was often compared to the traditional e-commerce rivals like Jingdong and Pinduoduo. Simply put, Alibaba struggled in the low-cost segment against Pinduoduo and couldn't compete with Jingdong in high-end markets. In entertainment, food delivery, and various sectors, it faces fierce competition from Meituan and Tencent. This leads to pessimistic market expectation, resulting in a valuation of around 10 PE ratio. If we're still viewing it as a consumer company, that current 90 PE ratio might seem a bit high, right? But overall, given the shifting landscape, Alibaba is actually reshaping in the industry. On the one hand, they are pushing back against emerging competitors by launching content-driven products like Taobao Live to fill gaps and ramping up investment in price war to fend off Pinduoduo. And this year, Alibaba launched Taobao Flash Sale for instant retail, teaming up with Alibaba for massive subsidies to return users and transactions. Alibaba's entry has intensified the instant retail battle, pushing Meituan and Jingdong to ramp up with their competition, ushering the entire industry into a new phase of food delivery plus e-commerce integration. On the other hand, Alibaba is leveraging its ecosystem advantages to improve industry infrastructure. For instance, Cainiao Network has established logistics hubs and last-mile stations across the country, setting benchmarks for delivery efficiency. Alipay, provided by Ant Group, reduces frictions in the e-commerce transactions. All this solidifies Alibaba's influence in the industry. Even though they are facing challenges with user traffic, their role as a foundational e-commerce infrastructure provider remains critical. Alibaba largely sets the standards and rules of the game. The future direction of e-commerce will depend on whether Alibaba can innovate and break through in content, e-commerce, and local living sectors to lead new growth market. Here comes to the third factor. In my opinion, Jack Ma's return has brought a qualitative change to Alibaba. Since his return, we've seen significant adjustments in Alibaba's organizational structure. Zhang Yong stepped down, Jiang Fan returned to the e-commerce division, and Zhou Cai took over as chairman, while tax expert Wu Yongming stepped in as CEO. Alibaba's strategy has shifted from focusing on consumer upgrades to a user-first, AI-driven approach. As Alibaba's investor, maybe we're more focused on this question: what should Alibaba's target price be right now? Alright folks, let's tackle our final question. What's the reasonable target price? When we dive into the valuation and investment outlook, based on a projected PE ratio of 19 for the 2027 fiscal year, Alibaba is facing some short-term investment pressure. But the AI narrative is still looking pretty constructive. Their core businesses Taobao, Tmall, and cloud services have performed slightly better than expected. However, the market may not fully reflect the short-term commercial losses and the hefty AI investments being made across various business segments. As a result, this report has suggested the earnings per share expectation for the 2026 to 2028 fiscal year down by about 4 to 8%. Overall, Alibaba's investment thesis remains centered on its robust potential in cloud computing and artificial intelligence, making it one of the cheapest AI stocks globally. In the short term, given that Alibaba stock has significantly outperformed the market, I calculated it's up 190% year to date, we might see some consolidation pressure. But looking ahead, it executed well. I also have to mention the risk factors of these investments. Investors need to keep an eye on several key risks. Regulatory changes, especially regarding data usage and online content. Microeconomic headwinds in China and globally, competitive pressure from traditional brick and mortar retailers, potential IT disruptions, short-term profit pressure from long-term investments. The complexities of multi-platform operations, corporate governance issues like the significant voting control held by Alibaba's partners, and the impact of founder Jack Ma stepping back. Now, here are a few specific risk points to watch out for. Firstly, about 30% of Alibaba's current revenue comes from its e-commerce segments. To fund such massive investments, they will likely need to raise fees for the merchants, right? As we discussed earlier, Alibaba's monetization rate is already at 5%, meaning for every 100 merchant sales, 5 yuan goes to the platform. It's becoming tougher to make money on the platform, and with these new investments, merchants might really feel the pinch. Second risk is come from Pinduoduo. Of course, it's still eating into Alibaba's base with its low price strategy, and its net profit is now nearly on par with Alibaba. Third one is, with all this investment, how much will AI-related revenue actually increase? Currently, cloud services and AI make up just 13% of Alibaba's total revenue, so that's something we need to keep a close eye on. Well, my friend, look at NVIDIA, a recognized leader in the AI space, and its stock has skyrocketed over the past 5 years, but they're making real money. NVIDIA's revenue has doubled every year for 5 years straight. Alibaba's tech capabilities are strong, and it's a leader in the domestic cloud services market. Rumor has said that Apple considers Alibaba one of its main partners for AI in China. But all that technical prowess and investment needs to translate into actual revenue to support Alibaba's stock growth. So Alibaba's AI needs more time. Well, my friend, that's all for today. If you want to know more about Alibaba and other Chinese concept stocks, you can follow my channel. See you next time.